Hello everyone, welcome back to another episode. I'm your host, the Millennial Investor, and today we have a very fun video to go over. We're going over an ETF. The ETF that we are going over is SCHD, not to be confused with the one that I've reviewed in the past, SPHD, with the letter P. We're going over SCHD. In my opinion, I think the SCHD is a lot better than SPHD, but SCHD is a very good ETF, and I want to go over all of its holding in this video. So we're going to do a lot of different things. Now, but first off, before I get any further into the video, I did want to give a shout out to Tom Settles. When I made this video breaking down SPHD, he wrote this comment saying, "Great analysis of SPHD. Could you make a video on SCHD? I think it would be a much better dividend ETF, but I would like your opinion." Now, I saved that comment from 4 months ago. I had this written down in my notes. I've been trying to make a video about this forever, but I constantly have new video ideas popping up. So thank you very much, Tom Settles, for recommending this, and I'd love to get into this ETF with you guys. So what we'll be doing in this video is we'll be going directly to Charles Schwab. We'll be looking at some of the information about how they run the ETF, what their expense ratio is, what some of their top holdings is, how the performance is done compared to other metrics like the Dow Jones, and basically just give an overall view of the ETF in general. And I also wrote down, now you're welcome to pause this at any time. I will, at the end of the video, scroll through the whole list so you can see it all. But I went ahead and found the entire list of 104 holdings. If we scroll down here, M1 Finance says that it has 104 holdings. Well, I went ahead and in order from largest to smallest, got a hold of 104 of those holdings. So you can see them all right here. We'll be going through all those. And basically what I wanted to do is just scroll through the top 50 and just give you my opinion on the top 50 going all the way down to right here to Franklin Resources. But what I wanted to do in this video is that I really wanted to focus on breaking down as far as the stocks go. I really wanted to focus on the top 10 holdings because the top 10 make up the bulk of this portfolio. I would say probably half the portfolio just come from the top 10 holdings alone. But the top 10 are, from smallest to largest in the top 10, are Verizon, Coca-Cola, Pfizer, 3M, IBM, Pepsico, UPS, Texas Instruments, Qualcomm, and BlackRock. Now, even out of that top 10, I own 1, 2, 3, 4, 5 different holdings of the top 10. So this portfolio very much relates to me. But overall, guys, speaking of my portfolio, before we start diving into all that, if you're not familiar with me, if you're not familiar with my channel, my name is Jordan. I'm the Millennial Investor. I track my annual dividend income, my monthly dividend income, my portfolio, and my monthly YouTube income through these 4 charts right here. And these are the 27 holdings that I own. This little column on the left, these 27 holdings are what I have right here, and these are what they pay me on an annual basis. And this is updated every single month. And if you want to see my YouTube income, there it is broken down by category right there. I'm fully transparent. I disclose everything. My buys, my sells, my dividends, the money I make from the channel, absolutely everything. So if you guys want to see an investing journey from scratch, starting with $1,500, getting hopefully to $1 million one day, then follow along with me, and I'd invite you guys to subscribe. And if you want to support the channel, one of the ways that you can do that is you can go to the description. In the description, there's things like mentoring calls, savings account referrals like Toyota savings accounts and credit cards, and especially most of all, there's a referral link to my portfolio and to M1 Finance. This brokerage is absolutely free to use. I know there's been a lot of issues with Robinhood lately, so if you're worried about security issues and you want to move your money to a more secure location that is very good for dividend investors, we have 47 people signed up through this link. Go ahead and get this number to 48. Go ahead and get this number to 50. I'd really appreciate it. And if you do that, it would help contribute some cash to my channel if you download and deposit $100 to the platform, because that $10 is just going to go straight back into the portfolio, which will help grow these holdings and grow our dividends. But thank you guys so much, and we will go over my portfolio at the end of the video. But if you just want to see the 27 holdings that I have, here it is right there, and you can scroll through, and yeah, like I said, I own 5 of the top 10 of these holdings. Now let's go ahead and go into SCHD here. Let's go ahead and Google it, SCHD. Now SCHD basically is tracking the top 100 dividend stocks that are in the Dow Jones, the Dow Dividend 100 Index. Now, those of you that don't know, the Dow Jones is primarily made up of 30 stocks, right? So if we go to DIA here, if we go to DIA, and this is the Dow, this is the spider ETF that a lot of people focus on investing in, the Dow ETF, which is DIA, that ticker symbol. Right now, it has an expense ratio of 0.16% and a dividend yield of just over 2%. But if we go to Charles Schwab SCHD here, their ETF has an expense ratio that is about half that price, a little under half that price, of only 0.06, and its dividend yield is over 3%, about 3.2%, right around the time that I'm filming this. So a much significantly higher dividend yield, and that's because these stocks in this portfolio are only focused on the top 100 dividend stocks that are in the Dow Jones, right? It's not focused on just the top 30 composed of dividend and non-dividend paying stocks. So this really gives you a good yield. And in my opinion, as we get further into this video, I'll show you my reasons why. I've always said that if you want to buy an ETF, you should be buying either SPY or VOO. Now, if I were forced to invest inside of an ETF and I couldn't choose VOO, or I couldn't choose SPY, I couldn't invest in just the S&P 500 index, what I would probably do, I would definitely consider adding a whole bunch of this into SCHD. It seems like a very good holding, and I'll go ahead and start showing you my reasonings for that now. So SCHD, this is the Charles Schwab website right here. The website, if you want to look this up for yourself, is swabfunds.com/product/SCHD, and the highlights: a straightforward, low-cost fund offering potential tax efficiency. The fund's focused approach can complement a diversified portfolio. Tracks an index focused on the quality and sustainability of dividends. Invest in stocks selected for fundamental strength relative to its peers based on the financial ratios. So if you see, here's some of the main bullet points here about whether stock is trading, what the price is at, and if it's at a premium or a discount. And if we keep scrolling down here, like we said, that expense ratio is very low, and they have 104 different holdings, so they're definitely diversified, like it says in one of its highlights right there. We can keep on going, and we find a lot of different things like its yield. We look at its performance compared on a monthly and quarterly basis to the index, and you see here, I want to scroll down to this chart. So this is the SCHD ETF compared to the Dow Jones 100 Dividend Index, right? And you see that this little blue line and this little gray line are the two indexes, and they are pretty much identical. So when you look at this and you're thinking to yourself, okay, this probably has similar performance to that of the Dow Jones, but it offers a much better dividend yield, and I think gives you some opportunity. So we keep on scrolling down, and the main thing I wanted to look at here is right about here, these top 10 holdings, because this top 10 list basically makes up half of the ETF, and I want to just go over these 10 companies real quick and give my just basic opinions on them. BlackRock is a very long-term company with an incredible track record. BlackRock, if you want to read a description right here, if we go to the 5-year chart and then scroll down, M1 Finance says BlackRock engages in providing investment management, risk management, and advisory services for institutional and retail clients worldwide. Its products include single and multi-asset class portfolios, investing in equities, fixed income, alternatives, and money market instruments. Now, if you look, BlackRock has currently a 2+% dividend yield, and it just hit its all-time high at $656 a share, currently paying out about $3.63 a quarter in dividends. And this company is a very old blue chip stock that I think is great for someone that is wanting to invest in very safe dividend companies. Now let's go ahead and go to number 2. This is one of the holdings that I have, and it's a little bit surprising that it's such a new age stock is going to be in this portfolio. But Qualcomm is the second largest, and by the way, I probably should have mentioned, as you can probably see this list, these numbers on the right side of my email, which we'll be going over in a second, all of these are percentages, so like 4.41% of the portfolio, 4.31, 4.17, you get the point. But Qualcomm is actually in my portfolio as well. And I started buying Qualcomm at around $69, $70 a share, I believe is where I first started buying it when the recession started taking place. And Qualcomm is a huge opportunity stock for the future with 5G. One of their number one clients, by far their number one client actually, is Apple. If you believe in Apple, the largest company in the world, they are currently a $2 trillion company, $2.1 trillion, and this company produces millions and millions and millions of iPhones all around the world. And guess who is one of the largest provider for the microchips inside of those phones? You're looking at them, Qualcomm. Qualcomm is their go-to man for their microchips, and they're getting a ton of revenues from Apple. And I think especially once 5G rolls out and the demand for those chips increases quite heavily, I think that they're going to continue to grow revenues, and that dividend is going to speed up its growth quite a bit, I think, over these next couple of years. But Qualcomm is the stock that I own. It's about 2% of my portfolio, and I've done very well on it lately. Number 3 is a stock that I do not own currently, but is one that I definitely have considered owning, which is Texas Instruments. And Texas Instruments, if we go right here, TXN, Texas Instruments is once again another microchip company. They have a lot of other different categories as well, but they're mostly focused on things like microchips. And right now they've been growing that dividend pretty much every single year. And Texas Instruments is a very old blue chip stock. I've actually had a few family members actually work for Texas Instruments, and they're an incredible corporation with a lot of benefits, treating their employees very good. And overall, they're just a revolutionizing company. I think that this company is going to be very successful for the long run. And the only reason why I do not own Texas Instruments is that I already own Broadcom and Qualcomm, two microchip companies, so I don't want to get my exposure too heavy into microchips, but I have Qualcomm at 2%, and then my largest investment, Broadcom, is at 8%. So I don't want to get too heavily invested in microchips, but that's the reason why I don't have Texas Instruments, but it's a great investment. And the next stock, another one that I've considered adding in the past, is UPS. Now, UPS is a delivery service. You've probably seen them before delivering packages, and they are one of the largest in the category on planet Earth. Now, the good news is, because of this recession, the shutdown has taken UPS stock to sky-high levels. No one ever could have predicted the stock would ever get to this price a year ago, 2 years ago. And you see that the stock 5 years ago was $104 a share, $105 a share, and today it is at $175 a share. It really got hit down hard from the recession when everything was being sold off, and then people realized, hey, the shutdown's happening, and people are going to be having everything shipped to their house. So UPS definitely had an increase in demand in 2020, and this really helps their business model. And overall with UPS, the main reason why I don't invest in them is for one reason, and that's a simple fact, the big question mark with Amazon. Who knows if Amazon is going to be able to really hurt revenues for a company like this? But regardless, I think it's a very great blue chip stock that is very dominant in its field and is probably going to be around for a very, very long time. Now, if we go further here, and we go to the next stock, let's go to the number 1, 2, 3, 4, fifth largest holding. Number 5 is one that is one of my largest holdings, which is Pepsico. If we go to my holdings here, and we go to my greatest holdings here, my largest holdings, it currently makes up 5% of my portfolio. So Pepsi is a stock that I'm very bullish on for the long run. I've mentioned a lot of things recently with Coca-Cola and Pepsi, and how I think they're pretty undervalued at these levels, and they have great dividend yields considering where they're at. But between all the brands that Pepsi has to offer, with Cheetos and Tostitos and Doritos and Gatorade and Pepsi and SodaStream and all different types of other brands, is those snack foods and those beverages that Pepsi owns, pretty much all of them, right? When you walk into a 7-Eleven, when you walk into an OnQ, and you see that huge array of beverages and snack foods, guess what? Pepsi probably owns half of them in the store. So if you buy any of those, more than likely they're probably profiting off of it. And I'd pretty much just believe with the incredible track record of raising its dividend for decades and decades in a row, I think that Pepsi is not only going to continue to raise that dividend, but probably go up in share price in the long run. International business machines. I don't want to go over this too long. I just made an entire video about IBM, and IBM I think is really struggling from this recession. They are trying to turn things around. They have a pretty risky dividend, but that said, I think that their CEO is starting to get things done with their acquisition of Red Hat and overall just trying to turn around the business model. They're basically referred to as a boomer stock, as that they're pretty much old school and pretty much outdated. But regardless, if they're able to turn things around from a value proposition, buying the stock now at these levels offers some pretty attractive prices. So if you're interested in that, go ahead and check that out. And I think IBM is a pretty decent holding for this portfolio. Next up, we have 3M. Once again, one of my largest holdings, currently makes up 5% of my portfolio as well, just like that of Pepsi. And 3M is a great company. And I mentioned this before in some of my portfolio reviews. One of the reasons why I like 3M is because they're so diversified. You will not find any company in the stock market that has a more diversified revenue stream than 3M. And that is because they currently offer 56,000 products. You heard me right. 56,000. I've never heard of a company that has 56,000 products, but you're looking at them, and 3M, once again, has raised its dividend for over half a century. I'm going to say that again. It has raised its dividend every single year for over half of a century. And the fact that now it's being traded at pretty reasonable prices and has a growing dividend every single year and almost yielding 3.5%, I think that it's an excellent stock to hold. And in my opinion, I just think this is too good to pass up on. Next up, we have Pfizer. It's the same reason that I don't own a stock that a lot of people talk about. A lot of people talk about for dividend investors, both yield and dividend growth investors, a lot of people look to AbbVie. And in full disclosure, I've really considered adding AbbVie to the portfolio, but regardless, one of its main competitors is Pfizer. Pfizer's is another pharmaceuticals company, and one of the main reasons why I do not own this company is just for the simple fact that I do not understand pharmaceuticals. I don't have a big of a trust in their business models as I do compared to other things. Like a 3M, I understand how they make their products and deliver them to consumers. Pepsi, I understand their beverages. I understand their snack foods. I eat them and drink them every single day. But when we look at Pfizer, a lot of these drugs, a lot of the stuff that they produce are things that I've never seen, I've never heard of, and I pretty much just flat out just don't understand what they do. So that said, from what I've had to hear about Pfizer and what little research I've done about it, I think that it seems like a pretty solid company with a growing dividend every single year, currently yielding about 4%, very similar to that of, say, an AbbVie. But I think this makes up a pretty good holding in the portfolio, getting diversified a little bit, and I think considering that it is a pharmaceutical company, and in its top 10 I don't see any others in here, I think that's pretty good for diversification with a pretty good dividend yield and a growing dividend at that. So, and I think 8th largest in the portfolio pretty much makes up a good percentage as well at 3.87%. But next up, number 9 at 3.81%, we have Coca-Cola. Once again, another one of my largest holdings. Coca-Cola currently makes up about 4% of my portfolio, and I made videos about Coca-Cola recently. They're looking at ways to increase revenues, and they're doing that through a couple of different ways. One example is they're changing their packaging from the traditional 16-ounce Coca-Cola cans to smaller cans with higher margin. They're also about to start offering Coca-Cola with coffee, a new spin-off on its brand, a new way for them to grow revenues, and then last but not least, they're also coming out with an alcoholic beverage. That's right, they're coming out with an alcoholic beverage that is the first time that has been seen throughout Coca-Cola for the first time in decades, but they're coming out with Topo Chico, a hard seltzer that is coming out in a couple of months, and that is once again going to be another way that Coca-Cola is going to grow revenues. But between all the different products that Coca-Cola has to offer, just in the description you can see a couple of them. Coca-Cola, Diet Coke, Coca-Cola Zero, Fanta, Sprite, Minute Maid, Georgia, Powerade, Delval, Schweppes, Aquarius, Minute Maid Pulpy, Dasani, Simply. You get the point. There's so many different things that this company has to offer in the beverage industry, and other than Pepsi, they're by far the most dominant in the beverage space, and they just have a great reach globally, and I don't think that's going to stop anytime soon. Basically, the way I like to put it when I talk about Pepsi and Coca-Cola is that if you believe 10 years from now, 20 years from now, that humans are going to need something to drink, then more than likely then these companies are still going to be around and growing revenues and dividend and share price every single year. Great holding there by SCHD. Last but not least, we get to number 10, 3.71% of the portfolio. Once again, another one of my holdings. It currently makes up 2% of my portfolio, and I'm currently up on it, is Verizon. Verizon has had some stagnant share price growth over the past 5 years, just barely up from where it was 5 years ago, but it's been growing that dividend every single year and just raised its dividend about a week or so ago. They just claimed dividends actually about a week or two from the time I'm filming this video, and currently yields over 4%. So as far as steady income, now let's fast forward a bit. Now, right now, I'm 21 years old. Basically, I just get it for the yield and the steady defensiveness that it comes along with owning a telecommunications company. But if you're retired, if you're watching this and you're 40, you're 50, you're 60, and you're wanting something that is defensive with a great dividend yield, well, you're looking at it. Verizon is one of the best retiree stocks in my opinion, and it doesn't come with nearly the amount of risk that AT&T does. Verizon is a solid telecommunications company, and even as you're watching this, you might be watching it on a cell phone, and who knows, you might even have that cell phone provided by Verizon. But overall, I just think that Verizon offers some great defensiveness, some great dividends, and overall just some great growth on both share price and dividend yield. So overall, how do I rate this portfolio? If I were to give it a 1 out of 10, I would rate the top 10 holdings. I gotta be honest, guys. I think I would rate it a 9 out of 10. I think that some of the companies they have in here have some great yield, some great opportunities here. I think there's some companies that should be added to this list that are not added. Just to give a couple examples, like Johnson & Johnson should probably be in here. But regardless, I think these are some great companies, and these top 10 holdings are awesome. Now, I wanted to just go through here, and I'm going to slowly scroll through. So go ahead if you want to see any of these top holdings. This is in order from their top holdings to their bottom holdings. So right now, if you want to pause the video at any time, go ahead and look at these holdings. Once again, sorted from greatest to least. And the reason why I'm showing this, if you're either already invested in SCHD or if you're wanting to invest in SCHD, it is usually hard as a new investor to see what exactly you're owning, right? Because if you're new and you don't really know what to look for, what exactly do I own? Once I got to the top 50, I started just getting into a list view right here. But these are the top holdings that it has, and you see the percentage. We're starting to get pretty thin here. Like I said, most of it is its top 10, and especially once you get to a top 50, you pretty much have nearly the whole portfolio based on weight. But these are all the holdings that it has, and if you want to see the tickers, we're about to get to the bottom right here. If you want to see the tickers of any of these, I'll just scroll through. These are the tickers to all those stocks that you just saw. And if you want to look any of them up, you want to do some research for yourself, or if you want to just see the individual stocks, go ahead and look up these tickers or the names of these companies, and you can get a full idea of what this ETF owns and if you decide whether or not you want to invest in it. But overall, guys, I think SCHD is an incredible ETF. And honestly, if I were to recommend anything to anyone that wasn't VOO or SPY, PS, like I mentioned, if you're wanting to invest in ETF, I still think VOO is the way to go. Just a basic S&P 500, very safe, very simple. But if you're wanting to own a different ETF, especially if you want to be a dividend investor, hey, SCHD is probably the way to go, especially if you're older in life and you're wanting to live a little bit off that dividend yield rather than off the dividend growth. But thank you guys so much for watching all the way to the end. If you're new to the channel, go ahead and subscribe. I'd invite you to do so. Like I said, if you want to see me update these charts every single month, if you want to follow along with me and give out some great information about ETFs, about dividend investing, about bonds, about the stock market in general, go ahead and subscribe to me and follow along. And like I said, if you want to support me, if you want to support the channel, one of the ways that you can do that is through this link right here. We have 47 people signed up. Let's go ahead and get that to 48, 49. Let's get that to 50 people referred, and you can get $10 for doing so. If you just download this app and you deposit $100, you will get 10 bucks. Free 10 bucks. You don't have to do any work whatsoever. Just sign up, and that would help me in my channel, help me grow this channel. But thank you guys so much. We're doing really good with our investments. I'm about to break $7,000 in the portfolio, and right now my dividend income is getting up to $20 a month. So pretty good here. So thank you guys so much for watching. Leave me any comments down below, down in the comment section, and I'll love to answer any questions that you guys have. But thank you very much, and I'll see you guys next time.